Hi, I'm Grant Stephen.
And I'm Kris Bernier.
And we're the two investment guys. This week, Kris and I want to talk a little bit more about some of the market drivers. First, we'll look at global stock market returns so far this year as we're closing out the year. We've got the TSX up about 6%, whereas the S&P 500 in the States is up 24%. And when we look to Europe, we see London up 9%, France is up 11%, and Germany's up 19%. And in the Far East, the major markets over there, well, Hong Kong is up only about 1%, but Tokyo is up 46%. Kris, that's a story unto itself that maybe we'll save for another day. But we wanted to talk a little bit today about the notion of tapering that you hear a little bit about and the effect that that may have on sentiment.
Sure, well, if we take a step back and we talk a little bit about these words quantitative easing, essentially what the Federal Reserve has done in this current round is round 3, is basically increasing the money supply and out buying treasuries and mortgage-backed securities in the open market to try and keep interest rates low. Remember, one of the key drivers of the recovery in the US has been the housing sector. Mortgages are priced off the bond market and they want to make sure that the housing recovery continues. So that is really what they're talking about. Now in the first round of quantitative easing, Grant, in the second round, they actually just ended the programs. They telegraphed that to the market, the programs ended, the markets pulled back rather sharply. In this round, they're talking about tapering. And tapering is really just reducing the bond buying in the open market over a specified period of time.
Right. And so the point there that ties to sentiment is that, you know, in April we had a little shot across the bow in early May, and markets got nervous and anxious about that. And now that better understanding the timing of this and the potential impacts of this, well, the market sentiment has been more neutral on it as opposed to negative. We want to turn to some of the equity drivers that we see now in the market that are providing the positive trend here, and primarily, Kris, it would be the jobs report.
Yeah, absolutely. If we turn back to the fundamentals, the things that actually drive equity markets, not quantitative easing, it's the jobs data, it's the accommodative monetary policy. In other words, interest rates in and of themselves are at multi-decade lows, and profitability of corporations continues to improve.
Yeah, and so why do stock markets go up? Well, there's a thing called price earning multiples, and that allows them to expand and go a little bit higher. So we see those three fundamentals quite strong and stable at the moment, and probably not going to be falling off a cliff like what we got used to over the last 4 or 5 years. You know, so now, Kris, when we see pullbacks like this, I think they're to be viewed as a buying opportunity really more than anything.
Yeah, absolutely, and it's not just about the US. We're seeing improvement in Europe, we're seeing improvement in other parts of the world, and as we get this global coordinated growth, we're going to see that multiple expansion. So, you know, use those pullbacks as buying opportunities. Again, we want to thank you for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. Kris and I are going to turn a little bit to our 2014 forecast. So until then, I'm Grant.
And I'm Kris.
And we're the two investment guys wishing you all the best for the holiday season.